In the last week, the British banking industry has been hit by yet another scandal, this time over the manipulation of LIBOR rates. I'm joined by Professor Philip Booth, who's going to talk to us more about this story. Philip, first of all, what exactly are LIBOR rates?
Well, essentially, LIBOR is the rate of interest at which banks lend to each other. And it's important because a lot of financial contracts have their interest rates based on LIBOR, so in some way they're pegged to LIBOR. So if a bank, for example, lends to a large company, it may lend at an interest rate which is set according to the level of LIBOR plus a margin of 1 or 2%, for example.
Okay, and obviously we've been hearing a lot about it in the last week. What is it exactly that Barclays are accused of having done?
Well, every day the major banks put in a submission to the British Bankers Association, who calculate LIBOR, and in that submission should reflect the rates of interest at which those banks actually have to borrow money. And Barclays are accused, and there are other banks likely to be involved in this too, just Barclays are the first to be investigated. Barclays are accused of having manipulated the inputs into that calculation. So the information that they've reported to the British Bankers Association, it's suggested, is not correct information. And they've done that in order to, it's alleged, in order to have to take advantage of particular trading positions that they've got, and also perhaps to give the impression to the markets that they're able to borrow at lower rates of interest than they actually have been able to borrow.
So what exactly can be done about this? I know the government suggested some sort of regulation.
It's quite difficult to know what can be done about it, really. To some extent, it's an ethical problem. But the government's idea that this should be dealt with by regulating the calculation of LIBOR, I think, is really completely a red herring. The government is suggesting, partly in order to put the blame, I think, on the last government, that this is a gap in the regulatory framework, that the calculation of LIBOR is not regulated. But actually the provision of the information which is used to calculate LIBOR is a regulated activity, and that's what went wrong. The actual calculation of LIBOR was correctly done as far as we know, and that aspect of it is not regulated. And I think it's just very difficult to deal with these sorts of problems by the production of more and more regulatory requirements, when actually at roots there is an ethical problem here, and a cultural problem perhaps in the way in which people within large banks are behaving. And I think we probably need a different approach.
So if the answer isn't regulation, what could be done about this?
Well, first of all, banks' boards obviously have to take responsibility for the culture which develops within their own institutions, and they should be responsible for that and held responsible for that. But also it's been suggested that there are various loopholes in the civil and criminal codes, so that it might not actually be possible to prosecute the people involved for civil and criminal offences. If there are such holes, if there are such gaps, then certainly those gaps should be filled. I mean, really this problem is a problem of banks for their own benefit, or particular staff in banks for their own benefit, trying to manipulate the information that's given to another organisation to calculate the LIBOR interest rate. And in the process of this, other people could have lost money, perhaps lost considerable sums of money. And to me, that is a straightforward problem, either of criminal fraud or some kind of civil offence which should be prosecuted through those mechanisms, rather than trying to develop more and more detailed regulation to actually regulate the behaviour of the people involved.
Philip Booth, thank you very much for joining us.
Pleasure.